Today what we want to do is continue our discussion of money, monetary policy, and so forth. And what we're going to talk about is something called the money multiplier, which is kind of an interesting term. That's what I need, is a money multiplier. This is really, it comes down to some mathematical formulas and stuff like that. It's not very complicated, not very difficult. But surprisingly, economists didn't figure this out until in the 1960s, I think in the mid to late 1960s. And so until then, this whole process that we'll be talking about today, this whole process was going on, and people didn't really understand it. And we will see when we get done with all of this that part of the story behind what happened during the Great Depression, part of that story is explained once you understand this money multiplier process. What we're going to do is build up to some formulas, but we don't start off with the formulas. We start off with a common sense kind of an example. And once you understand the common sense example, then the formulas, you know where they come from, what they mean, and how to interpret them. So anyway, what we're going to do today is sort of make up a simple little economy. It's mainly a people and a banking interaction, but a little economy, and just talk about how things would work out in that situation. And then we'll see this money multiplier emerge. As I say, it wasn't until the 1960s that economists had this figured out. And I read the article, when this was first done, and I thought, yeah, so this is obvious, because I had learned it as an undergraduate, and I didn't realize when I learned it as an undergraduate just how recent it would have been. I would have thought, 100 years ago people would understand this. So it's really not been that long ago. As I said, this has been going on forever. If I wanted, I could tell the story and say, this is the way it worked during the days of the goldsmiths. And you remember the idea in England and the goldsmith, and people put gold in there and they get these warehouse receipts they could use as money. Well, this process took place then. Or this process took place during the early days of the United States from 1776 up to 1863. You remember what we had was these state-chartered banks, and they were issuing their own currency. Well, this process occurred then, and nowadays it occurs with the Federal Reserve. And so it's really the Federal Reserve that is driving the process now. But I don't want you to think there's anything about all of this money multiplier stuff that's new or recent or just confined to Federal Reserve days. What really causes this all to happen, what drives it, is this process of fractional reserve banking. The fact that banks do not keep 100% reserves. When you make a deposit, they hold some of that on reserve and loan the rest out. Why do they make the loans? For the profits. And we've talked about how the high interest rate on bank loans. The general idea is this, and then we'll get into it, is here's the economy. And here's the Federal Reserve, and this is our modern-day institution that we'll use as the outside agent. The Federal Reserve injects $1, let's say, into the economy. We'll call these bank reserves. And then what happens is we notice that, hey, within the economy there's an increase in the money supply of, let's say, $3. And it's like, how could this happen? How could $1 become $3? And the answer is there's a multiplier. And how much is the multiplier? Is 3 in this particular case. And I'm using these numbers as just, hypotheticals. Now, people didn't know about this before because, if we went back 200 years ago and you told somebody, hey, $1 gets injected in the economy, it turns into $3, people would have started scratching their heads and said, how can that be? And they would have gone to work on that and figured out the answer, because the math is not hard. The only thing is 100 years ago, nobody knew these numbers. There was nobody measuring the money supply. And that being the case, you go, well, okay, money comes in the economy, there it is. And that's the end of the story. Well, the thing is, if you don't measure how much the money supply is, then you can't realize that there's this money multiplier process at work. It was not until 1963, I believe, it was the year of publication, that two people, Milton Friedman and a woman named Anna Schwartz, published a book, Monetary History of the United States. And this monetary history of the United States went back to the time of the Civil War and came forward to 1960. And what they said is this, and they wrote this monetary history and told all about money and how it affected the economy, but before they could do that, they had to have money numbers. How much was the money supply? And what they found out is you can't write a story of the monetary history of the United States without knowing how much money there was, and nobody knew. And so what they did is they went back, this is a monumental task, they went back and got records from old banks, banks that were still in operation, banks that had gone bankrupt and so forth, but they collected all of these numbers that were out there and would look at the bank's balance sheets to find out basically how much were deposits and so forth, and they put all these numbers together for thousands of banks. At one point, there were 30,000 banks in the United States. And they put all these numbers together and said, here's a money supply series all the way from the time of the Civil War up to modern days, 1960. And so it's at that point that you could say, oh, look at this. There's a certain amount of money being put into the economy by our monetary authorities, and yet the money supply is a multiple of that. How can that be? And then you'd start going to work and say, oh, I got the answer. Well, 1963 is when this book was published, and so what I'm saying to you is 5 years later, then the article came out that said, hey, here's the money multiplier, here's why it occurs, here's the formula for it, and so forth. And this stuff that we're getting ready to talk about, it's essentially the same way that the Federal Reserve officials who make policy, it's the same discussion that they have. It's not like we're giving you the easy version of it here, and there's a harder version later on, that the authorities rely on. Anyway, so what we're going to do is we're going to start off with the Fed injects $1,000 into the economy. We'll talk about how that is in a minute. And then I want to make a couple of other assumptions. Okay? The first one is this, is that banks hold 10% of checking deposit liabilities on reserve. Now, there's two kinds of reserves. You remember this when we talked about the bank's balance sheet. There's required reserves and excess reserves. So I'm just saying that this 10% is the total. So it includes both required reserves and excess reserves. And right now we're not going to distinguish between those two. Just 10% on reserve. Okay? And then the other assumption we make is that people and companies divide their monetary assets 20% currency, or capital C, and 80% checking deposits. Capital D. I guess the other thing I will say is this, is that banks loan excess reserves why? For interest. And so this is just the profit motive that's motivating them. That is to say, if you put $100 in the bank and bankers hold 10% reserves of that $100, then there's $90 of the 100 that's an excess reserve that they say, I'm going to loan that out. Okay? So this will motivate, this will underlie everything we do. Okay? And if you see me make a mistake on this, you be sure and tell me. So let's start off. I'm just going to call these transaction 1. And here's transaction 1. Now, how does the Federal Reserve inject dollars into the economy? Well, it's possible they could do anything. They could fly an airplane or a helicopter overhead and just throw $1,000 out. Too bad they don't, because I'd like to find that. But that's not what they do. What they do is they purchase something. They go out and buy an asset and pay with $1,000. Okay? Now, what assets do they buy? In real life, they buy Treasury securities. Okay? Treasury bills, Treasury notes, Treasury bonds mainly is what they buy. But we don't want to get into that now. We'll come back to that later on. we will assume that when they start this off, just to make it an easier, simpler discussion, we will assume that the Federal Reserve just buys something from someone, let's say a Treasury bond. That person gives a Treasury bond, and let's just say the Federal Reserve prints up $1,000 in cash and says, here you go. And so the Fed buys a bond and pays with $1,000 in currency. C. This transaction increases the money supply by how much? $1,000. You remember what the money supply is. I'll put it someplace up here. Money supply is equal to currency plus checking deposits. I also said traveler's checks, but the amount in traveler's checks is tiny. $6, $7, $8 billion out of a money supply exceeding $1 trillion. So we're just going to leave out the traveler's checks for now. Okay? So anyway, currency and checking deposits. And so what's happened in our story here is that the Federal Reserve said to somebody, here's $1,000 in currency. And this is how this whole process gets started. Okay? This is how money gets into our economy. The Federal Reserve gets the ball rolling. That's the central bank. And this increases the money supply by $1,000. And this is the end of the story. Back in the old days, that's what people thought happened. Oh, look, we get $1,000 injected into the economy. There's $1,000. The multiplier is 1. You put in 1,000, there is 1,000. End of story. Okay, but what happens next? Transaction 2. Person who receives this money deposits it in the bank. Okay. How much? $800 deposit. But if you'll remember, we've got this assumption that people only deposit 80% and then they keep $200 in currency. Now, let's look at this. What's the impact on the money supply in transaction 2? This person received $1,000, so the money supply went up. Now, what this person, all the person did is said, you know, I think I'll hold on to 200 of that, and I'll put the other 800 in the bank. The total money supply did not change. All that happened is we got $800 less in currency and $800 more in checking deposits. So transaction 2 has no effect on the money supply. Okay? And that's the way it is in real life. If you do business with your bank, put money into your checking account or take it out, that doesn't affect the money supply. It affects the composition of the money supply. Transaction 3. Bank, and we'll just work with one bank here so that we don't get involved in banks shifting funds among themselves. The bank, I'll say, not just bank, the bank holds reserves of 10% of the deposit equals how much? $80. Are you with me on that? It's an $800 deposit, so we got to hold reserves, because that's our assumption, of 10%. And so then it says, hey, we got $800 coming in. Somebody slid $800 across the counter to us. That's vault cash. Those are our reserves. We only have decided to hold 10% of those. We've got $720 in cash. What should we do with this? Answer. We loan it out. And loans, this is the 90%, or $720. Is this making sense to you? Why do they do that? For the interest. Okay, maybe you're getting 8% on the loan and 0% on the vault cash. That's pretty simple. You don't want to keep all this money just laying around. Okay, so here's the key, and here's what's driving our multiplier. The person who came into the bank and borrowed that money, they walk out with $720. Okay? So this increases the money supply, increased money supply by $720. Hey, thank you. $720. And so our money supply was $1,000, and now it's risen by $720. What makes this possible is fractional reserve banking. The bank's only holding 10%, and it loans out 90%. And so now, here's $720. The money supply at this point is $1,720. Okay? So, here's transaction 4. The borrower of 720 spends it. That makes sense, right? That's why people borrow money. I could say to purchase goods and services. What goods and services? Makes no difference. Now, transaction 4 is moving money from one person to another. Right? If I buy a go-kart from you for $720, I give you $720, you give me go-karts, the money supply doesn't change, and nor does the supply of go-karts. It doesn't change. The ownership of those assets changes. Okay? So then, no change in money supply. It's still $1,720. Transaction 5. The seller of the goods and services, this person that we just talked about, deposits what? 80% of the 720 in the bank and holds 20%, because that was our assumption, is of our monetary assets, we'll keep 20% as currency. Keep 20% as currency and 80% in the bank. Okay? And so if we do the calculation, 80% of the 720 deposits equal $518.40. And currency is 20%. What would that be? $144? What impact does this have on the money supply? I just received $720 from somebody else, and now I'm just deciding how much to hold in cash, how much to put in the bank. It doesn't affect the money supply. Transaction 5 is really like transaction 2. Okay? Where all I do is decide how much to hold on to and how much to put in the bank. So no effect on the money supply. Transaction 6. Is that right? 6? Yeah. What's the banker do? Bank holds 10% of deposit on reserve. Hey, how much is that? Pardon me?
Is it 518?
How much?
576.
Oh, I'm sorry. 576? Well, I'm glad that somebody's checking me. That was a test. I told you it didn't affect the money supply. 10% of the deposit on reserve, how much is that? $57.60. What did I do wrong? Oh, I know what I did wrong. So, $57.60, and then it loans out the rest, right? Loans 90%. How much is that? 0.9 times 720. 648. I'll put that in red.
Would you need 29 times 576?
Pardon me?
It's 576 times 0.9.
Okay. Hey, this is all a test, right? 0.9 times, I'm getting 576. That's exactly right. 518.40. There's the number I had a moment ago. I don't know how I got one step ahead. 518.40. Is that right? This goes into somebody's check, into their hands. Here you go. Somebody comes in and says, hey, I'd like to apply for a loan. How much do you want? $518.40. Here you go. And so this increases the money supply by 518.40. How much is the money supply now? A moment ago, it was $17.20. And so now it's $2,238.40. 22, did I say 38? 40. Now, there's more steps to all this, but right now, if we had to calculate what's the multiplier, $1,000 got pushed into the economy. We've now got $2,200, $2,238 in the money supply. The multiplier is already 2.2384. What's making this happen? It's the fact that we're holding fractional reserves and lending the rest, and when we make a loan, that adds to the money supply. Okay, I'm going to erase this just because I don't want a lot of this sort of trivial stuff put on here. So, transaction 7. The borrower spends $518.40 to buy goods and services. Okay, we're going to buy goods and services. What are we going to buy? I don't know, $518.40 worth of stuff. How much does that affect the money supply? Anybody? 0. Okay, so transaction 8, the seller, that is, of the goods and services, deposits 80% of the $518.40 in the bank and holds 20% of the $518.40. And so we'll see if we can figure out how much that is. 518.4 times 0.2, 20%. So the currency holdings, I just saw it and forgot, $103.68. Is that right? No? Okay. And deposits, $414.72. Is this right? Looks right. That's the 80%. How much did this transaction affect the money supply? 0, right? You get some money in your hands, $518.40, and you hold on to some of it, and you put some in the bank, and what you put in the bank is money supply, just a different form of money supply, checking account money supply. Okay? And then transaction 9. The bank receives $414.72 on deposit, reserves 10% of that, so $41.47, right? And loans $373.25. Is this right? I think it is. And this loan is made to somebody. They slide that across the counter to the borrower, and that increases the money supply by $317.25. And we had money supply a moment ago of whatever I said, $2,200. Now it's over $2,500, $2,600. I'm going to do one or two more of these, but I want to go back and just show this pattern that repeats. Here's transaction 3. The bank made a loan of a deposit. Well, first of all, transaction 2 was there was a deposit at the bank. And then if I jump 3 transactions again, there's another deposit. Okay? We get a deposit in the bank. And if we jump ahead 3 more, there's a deposit in the bank. Now we move down one to transaction 3. The banker that received that deposit holds some reserves at 10% and makes a loan of 90%, and that loan of 90% increases the money supply. And if we jump 3 transactions ahead, a bank receives a deposit, holds some on reserve, and makes a loan of 90%, and that increases the money supply. And now we've got transaction 9. A bank receives a deposit, holds 10%, makes a loan of 90%, increases the money supply. Guess what's going to happen in transaction 12? It will increase the money supply. You've been reading ahead. Okay. Let's do a couple more and then I will reveal the secrets. Transaction 10. Transaction 10 is going to look like transaction 7, 3 transactions earlier. The borrower receives how much? $373.25. The bank slides it across the counter. Here's $373.25. And a person says, thank you. How much does that affect the money supply? None. And spends it. Right? That's what we do with money. That's what I do with all my money and just a little bit more. Transaction 11, which explains the whole idea of credit. Transaction 11, then the seller of the goods and services sold things to that borrower. And right, that's why we borrow money from the bank. You know, you go into the bank saying, I got a plan. I want to buy a car. I want to buy a motorcycle. I want to buy a house. Or a business manager goes in and says, I want to borrow some money to buy a delivery truck or a dump truck or a road grader or something like this. We go in and take out these loans so we can spend that money. And so every time we've got a borrower, then the next thing that happens is that borrower takes that money and buys something. So the seller, what? Receives $373.25 and deposits 80% of it. How much is that deposit? 0.8. Did you say 298.60? That's what I got. And the rest is in currency. $74.65. How much did this transaction affect the money supply? Not at all. I got some money. If I'm the seller, I got some money from that person that bought merchandise from me. I put some of it in the bank. And what I have in the bank now, my checking account, is money. So I just transformed one form of money, cash, into another form, checking account money. Okay? Transaction 12. Now we've already heard from Hope what's going to happen next. It's like transaction 9. The bank holds reserves, how much? 10% of the deposit. That deposit was $298.60, so I'll write the word down, reserves. Holds reserves 10% of $298.60, $29. And loans, 90%, right? $268.74. And loans, $268.74. And that increases the money supply. Let's go through here quickly. 268.74. I'm going to add these amounts up that the money supply has gone up. Plus 373.25. Plus 515. 518. 40. Plus, what was our last one? 720. Plus $1,000, $28.80, 39. Is that what anybody else said that?
28, 79.
Yeah, I think you've been rounding off too much. 28.80, 39. And of course, we're not done. But at this point, the money supply, what did I say? 28.80, 39. If we were at this point, somebody said, hey, how much is the multiplier? I would say this. 1,000 becomes $2,880.39. Then the multiplier would be 2.88039. Now, that's enough of that. We can go on. By the way, here's in real life, you get to a point where bankers say, you know, it's not worth doing the paperwork to make a loan of $11 or whatever. And that's what's happening is each one of these loans gets smaller. Here it was 720, 518, 414, 373, 290, 268. The numbers keep getting smaller and smaller and smaller. And you'll get to a point where a banker says, no, I'm not going to do it. But suppose we took this out and right down to the last penny when they go, oh, we have 1 penny over and above that 10%, make a 1 penny loan. And then we say, now we're done. Okay? And that's what would happen each time. Each one of these numbers is 72% as big as the one before. Here's what's happening, and I'll explain to you why this is 72%. Let's say that we started off with $100, and then 20% of that $100 would be held as cash, and the banker would only receive 80% of that. Because, I mean, that's what we're doing is we're talking about how big are these loans. The banker doesn't get a chance to loan out 20% because that person puts it in their pocket. And there's only 80% that goes into the bank. And then the bank takes another 10% and sets it aside in reserves, and there's only 90% of what remains that could be loaned out. These are called drains. This is the currency drain. That is to say, it's not available for additional loans. And then this is a reserve drain. Sort of like a bathtub. We've got a couple of holes in here, and we're draining these funds out of the banking system, where the bank just cannot lend it all out. And so, anyway, what is 80% times 90% is 72%. And so each time we go one more round and we give people an opportunity to hold some currency and bankers a chance to hold some reserves, then there's only 72% as much available for lending the next time around. And this is obvious. What I said, okay, let's start off with 100% or $100 or whatever. We start with 1,000, but let's just start off with this and say, hey, how about just lend it and lend it and lend it? And no, that can't happen, because what happens to that $100 is once somebody gets it into their hand, I've got $100 in my hand, then when I go to the bank, I say, you know, I'm not giving you this full $100. I'm going to put 20 in my pocket, and I'm only going to deposit $80, 80%. And so the banker says, thank you, here comes 80% in. And then the banker says, oh, of the 80% that came in, I'm going to set aside, the banker didn't know that was 80%, but of the $80 that came in, I'm going to set aside 10% in reserve, and I've only got 90% now of what remains for loans. And so this, if it came at the $100, then this becomes $80 is deposited, and then 10% of that's $8 would be set aside, and then $72 would be available to make a loan. And so that $100 in one round becomes, the next loan is $72. And so you can see, we started with 1,000. This became $720 the next time around, and there's no question about that being 72%. But $720 times 0.72 equals $518.40. Where was that? And then that $518.40 ends up being, well, loaned out to somebody, that somebody spends it, and the next person then holds 20%, makes a deposit of 80% of the $518.40. The banker then takes that deposit coming in, holds 10%, loans out 90%, and so we get down to that $518.40 times 72% is what? Oh, well, we already had it. $414.72. And then the $414.72 is a loan. Somebody borrows it, spends it. The recipient puts aside 20%, deposits 80%. The banker sets aside 10%, loans 90%. So now we got 72% of that. 373, then I've got 0.248. You know, it rounds off to 25 cents. 373.25. And then times 0.72 equals 268.74. Is that what we have? So what would we have in transaction 15? Times 0.72 equals, the next one would be $193.49. That would be transaction, what did I say, 15? Transaction 18. And these are the only ones that affect the money supply when a loan is made. So this is times 0.72 equals 139.31. And you can see this is going to get down to a penny if we go long enough. In real life, of course, it takes a few minutes to figure out, do all the paperwork for a loan. And in real life, the banker gets a percent, like 8% interest. And so in real life, a banker goes, just a second, I'm going to get $10 in interest on this loan for a whole year. No, I don't think I want to mess with it. That's the end. But we're trying to work out the theoretical possibility, and also the Federal Reserve doesn't start off at 1,000, they start off with $1 billion. And so these numbers are 1,000,000 times as big. This would be $139 million. And so banks continue making those loans. Somebody had their hand up?
Will banks even make a loan under $500?
Well, they can make a loan of 1 penny. Will they? I don't know. It just depends on the banker. And, you know, like if, let's say that you're a banker and here's your best customer, and this customer's been doing business with you for years. And they bring in their son or daughter and said, you know, Joni wants to borrow $3. Would you say no? Would you just go, no, Joni? I don't care. Just get out of here. You give her $3, but your customer wants you to make a loan. What would you do? You would make a loan of $3. What if Joni wanted to borrow 3 cents? You know what you'd do. Transaction 21. How much? Joni's going to get $100 and 31 cents this time. 72% as much every time. What do these all add up to? Boom, 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 boom. Well, only I know. And we'll talk about that in just a moment. By the way, all of these other things are 72% as much too. So, for example, there's the bank holding reserves of $80 in this round 3. If we go 3 rounds later from transaction 3 to transaction 6, this is 80% of the $80. 72% of that's this. And then if we go to transaction 9, 72% of 5760 is 4147. And so because of these 2 drains that we're talking about, every round, just the entire thing, every little piece of this is being scaled down by, except for the money supply, because the money supply is growing. But the changes in the money supply and the changes in bank reserves and the amount of currency that people hold, where was the currency? Here's $200, and 72% of that's $144. Where is it here? Holds 20, well, there's $144. And then 3 transactions later, 8, then this will be 72% of 144 is 103.68, and so forth. Everything is 72% as big. It's sort of like a pyramid, only it's inverted. Okay, we started off with 1,000, and then 720, and then whatever I said, $576. Is that right? Oh, 518.40. And so forth. And finally, these are going to get down to where Joni gets her 1 penny loan. And then we say that's the end. Yes, we could start lending out fractions of a penny. Is that legal? Yeah, anything's legal. You know, we used to have in this state fractions of a penny. You know, when you see gasoline, it would say like $3.04.9. But that's 0.9, 9/10 of a cent. There used to be tokens in this state that were, what's it called? Anybody know? It was a mill. A mill is 1/10 of a penny. And they never used them when I was growing up, but I saw them before. And there was a red one, and it was about the size of a nickel, but it was made of plastic. There was a red one, and that was 1 mil. And then I don't have a green marker, but there was a green one, and that was 5 mils. How ridiculous. That's back when something like a pack of cigarettes was, 14 cents or whatever, right? And then they start charging you sales tax on 14 cents, and then you start getting into fractional pennies. Anyway, have any of you seen those? Mills? Nobody? I had an aunt, and she passed away, and we were going through and sort of cleaning out her house and putting everything together. And she had these rolls that you've seen, like quarters rolled up or something like that. And I said, oh, look, there are, rolls of coins. And so I picked them up, and they didn't weigh anything. And so I opened up to look inside, and it was these mill tokens, and red ones and green ones. Really kind of weird. I mean, Anyway. So, made by the state. Yeah. Anyway, sort of a private money, wasn't it? It wasn't a national currency. So anyway, and so if we wanted to add all these up, we could obviously just do a huge number of these transactions, 80 of them or whatever, and add them all up. But once we know about this process, then we don't have to do that. Here's what we have, and we're going to do some more of this next time. But what we have is this, is that we have the money supply is equal to, and this is, by the way, currency plus checking deposits. Traveler's checks are not a part of it. I'm going to put a B here. This is from the Fed. And I said that that's only under the institutions we have today. Goldsmith days, it would have been whatever the gold miners find and works its way into the goldsmith shop and so forth. Times, and now I'm going to have some brackets in the numerator. 1 plus the ratio of currency to checking deposits. And this is determined by the public, right? You decide how much currency to hold. You decide how much to keep in your checking deposit. In our story here, what was that ratio? Does anybody remember? It was 20 over 80. So this is 0.25. That's just what I assume. Now, in real life, all of us are different. All of us make our own choice. But in real life, this number is pretty stable from one month to the next. Okay? And in the denominator, C over D again. So here that would be 0.25 plus the ratio of bank reserves over checking deposits. And this is at banks. Bankers decide how much reserves to hold, bankers and the Fed, as a ratio of checking deposits. And so here what we had was 10 to 100 That is to say, if a $100 deposit is made in the bank, they will hold $10 on reserve. This is 0.10. And now get your calculators out. So here's what we have. B, this is from the feds, $1,000 times 1.25 over 0.35. How much is 1.25 over 0.35? $3.57. Then what? 1, 4. Don't hold back. Let's make it 3. Okay, so $1,000 times that is equal to $3,571.43. Because I know what your next question is, and here it is. Do we have to know that? Yeah. 1 plus the currency deposit ratio divided by the currency deposit ratio and the reserve deposit ratio. And final point, this reserve deposit ratio is partly set by the Federal Reserve saying you must hold certain reserves, but also bankers can decide to hold some excess reserves if they want. Were you going to say something? Yes, I'll finish that next time. So long.